Before we start, I'd just like to say a quick thank you to our podcast sponsor, PensionBee, who are one of the UK's leading online pension providers. Now, PensionBee can help you transfer most of your old pensions together into one simple and low-cost plan, all through their app and online platform. Now, if you're looking for a low-cost, hassle-free way to consolidate your pension pots, except final salary pensions, that is, then PensionBee is worth considering, especially as it does not lock you in with exit penalties, which I really like. That's because it leaves you free to move your money at a future date if you so wish. I think it's a combination of investment fund performance, low costs, and its slick app interface, which has been integral in PensionBee gaining over 250,000 customers and receiving an excellent rating on Trustpilot from over 1,800 reviews. Now, you can sign up with the names of your old employers in 5 minutes. PensionBee's plans are managed by the likes of BlackRock, State Street Global Advisors, Legal & General or HSBC, and as always with investments, your capital is at risk. For more information, go to pensionbee.com.
Hello and welcome to episode 264 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leakes. Damien, we're here, we're remote recording from each of our homes. How are you doing?
I'm good. I'm good, Andy. And what's nice in a kind of retro way is that this is how we always did the podcast.
Yeah, that's right.
In the past, before you started working, or we worked together back at the beginning of 2019, we were always doing the podcast like this. And in the really old days, I used to drive to your house, didn't I? And we used to do the podcast before we worked out that the wonders of online Skyping and various different services. So yeah, it's a bit of a throwback, really.
Yeah, back to the old days. In fact, we were probably ahead of our times. We used to do the podcast together in a room, and then we realised we needed to socially distance in order to get the podcast done. No, we did it because it just made more sense and saved you having to travel 2 hours on a late Friday night up some dark country lanes.
Yeah, some dark country lanes, and inevitably I was scarred mentally by the Fox episode that occurred one night, but that's what happens in the deepest, darkest parts of Kent. Yeah, I'm good. I'm bearing up like everybody else. But one of the positives actually of us being in lockdown is, productivity, despite having children around, has been pretty good. And I don't think I've ever done so much video content as I am now. And every week we're doing the Facebook Live, which is gaining a lot of traction and proving very popular. So if you haven't joined that yet, if you go into our Facebook group, you go to facebook.com/groups/money to the masses. At the moment, every Friday at 12 o'clock, I'm doing a Facebook Live where I'm answering the questions that people pose during the live event and also during the week on a post that I put up. And it's proving very popular because I'm answering everything. Like today, it was defined benefit schemes, other pensions, investing, interest rates, mortgages, macroeconomic stuff. It was literally everything, budgeting, I think, and no matter what it was about money, it was involved in this week's show. So it's very good. Go and listen to that. I'm also doing some daily thoughts because one of the big bits of feedback we had last week is how much people enjoyed the podcast. And I listen to the podcasts we do. And last week, I listened to last week's show all the way through before this one, which I'm not sure if that's self-indulgent or actually just good practice, but it was a good show. We went through, and if you haven't listened to it, do listen to last week's show because it helped a lot of people feel a lot better about the situation that we are in and in relation to particularly their investments. So that sort of stuff I'm doing a lot more of in snippets on video about things that people should be doing for their own financial well-being at the moment and taking back control, because that is the thing that makes us feel more anxious, is when we lose control of situations. And we have all lost a lot of control over our lives and our financial lives. But if we can gain back some of it, it makes you feel better. It's about taking small steps and action. So I'm going to be doing a bit of that on this week's podcast. So just to tell you what's going on in this week's podcast, off the back of the success of last week's piece on investing, I'm going to do something around pensions. And this was born out of one of the conversations that happened in our Facebook group about somebody who is fast approaching retirement. So they were 3 years away. They were 52, hoping to retire and draw from their pension around 55, and their pension fund had plummeted in value. And they were obviously worried about it and what it meant. And it's the advice around that I want to talk about, which will make some other people just basically their options, and it isn't just doom and gloom. I also want to mention a little bit about taking back control of your money and things that I'm doing and I think others should do too. I'm going to do a little bit on the markets, very small piece. We don't want to keep dwelling on the markets at the moment, but it was interesting about what happened this week in investment markets. And I know you're going to do a piece, Andy, on insurance.
That's right. I've been delving into insurance. We've had a lot of questions about people wondering what they should do about their insurance. They've never claimed on it. Is it something that they need to consider cancelling? Will they be able to claim on it in the future? So it's really just a few pros and cons of cancelling policies, whether you should, whether you shouldn't, and what you need to look out for, really. And there's lots of guidance out there, but there's a lot of confusion too. So it's just a few do's and don'ts of cancelling your policy.
And that links quite nicely to the piece about taking control, because part of that will be about looking at where your money's going, what you're spending your money on. Let me jump straight into the investment piece. Just a bit of context, really, and just so people can look at what's happening in investment markets. Now, if you remember last week, and then you looked at what happened in the investment markets this week, or you watched what happened, you would have thought I was Uri Geller, or somehow predicted the future, had possession of some magical powers, because the stock market went completely crackers between Tuesday and Thursday. And I touched upon it in the midweek market show, but what we had was the second best ever day on the FTSE 100 on Tuesday, when it was up over 9%. We had similar moves in Germany. It was up nearly 11%, which was the third best day ever. We had the S&P 500 up over 10% on Tuesday, and this continued into the close of play on Thursday. And by the end of Thursday, I'm making this podcast during the day on Friday. By the end of play on Thursday, the Dow Jones in America had bounced 20% in 3 days. Now, that obviously sounds incredible. To bounce 20% in a space of a couple of days is quite eye-watering. And it led to some headlines saying the bear market is over and we've just entered a new bull market, because a bull market is defined by a 20% rise from a recent low. So it was now the Wall Street Journal, in fact, ran a story saying that it was the shortest bear market ever and we just entered a new bull market. And if you've listened to some of the pieces I've been doing in recent days and in the podcasts, I keep mentioning this phrase about a bear market rally. And last week I said we should expect to see one, and it will be really strong, and it will be some of the strongest rallies in equity markets occur in bear markets. And lo and behold, not more than 48 hours after that podcast went out, we had a rally start, and we got up, and I started naming some numbers on the S&P 500, and we actually got up near those. We at one point was at 2,641 on the S&P 500, so it's quite an astonishing rally, but it was to be expected. And while some people are getting excited about it, we just need to place it in the context of the market we're in. The VIX is still way up in 60 level. We've got a lot of volatility in other assets too. And if we look back at history, it suggests that this is inevitable, and it can be just a stepping stone onto a even further low, one lower than we had before. It's unusual not to test a recent low, so a retest of it. And so history suggests that we are going to turn around and start to fall back again. I'm not saying it will definitely happen, but history often rhymes if it doesn't repeat exactly. And although we had a 20% rally in the Dow Jones, it was still down nearly 20% from its recent high anyway. So it doesn't unwind all of that, because don't forget, if the market falls, whatever percentage it falls, it has to do more than that to get back to where it was. Use extreme examples. The market falls 50%, it would have to rally 100% to get back to where it was before that crash. So the other thing to bear in mind is that, to reinforce this really, I said the FTSE 100 had its second best day ever. The first best day ever was on the 24th of November 2008. The other 3 best ever days in the top 5 of best ever days, they also all occurred in 2008 and during that financial crisis. And what happened after all of those was the market didn't bottom until March 2009. So after the 24th of November, the market kept pushed up a little bit more in the sort of coming days and then weeks, and then crashed again, and it ultimately fell another 13% before it hit the bottom of the sell-off about 4 months later. So I'm not saying it will definitely happen, but I'm preparing people. That is what history suggests will happen. So although we get these rallies, they're exciting and everyone gets, the analysts and newspapers start shouting about it. A roadmap suggests we just need to be patient and things will take time to work out. For some people, they may exit on the way up, but they'll crystallize losses, but it may mean that they get out and then they're happy about that. They've been losing a lot of sleep and they shouldn't be investing in the first place. But I just wanted to place that just to show that last week we talked about this is what to expect. This is what we had this week. And we will probably turn over at some point and go low. Hope we don't. But as I say, there is a good likelihood of that. Right. Moving on. Pensions. Now, obviously, we're in an environment where our investments and pensions are falling in value. And there was an interesting discussion in our Facebook community group where a member wrote about the fact that they were 52, they were hoping to retire by 55. They'd seen their pension value fall from 400,000 to 300,000 in the space of a couple of weeks. Now, that's not unusual because if you think about it, it's about a 25% fall. And
I was going to say that's not too bad. Obviously, this person's a little bit older than I am, but mine's dropped by 33%, so that's not too bad, you know.
Yeah, and these are the sorts of levels that depend how you're invested in your equity mix, but in an environment such as we are in now, where all assets are all over the place, volatility is really high, correlations are all sort of heading towards 1, meaning that lots of assets are moving up and down at the same time. So when the market sells off, there's not much protection anywhere other than cash. In the thread, lots of other people said, yeah, mine's just as bad, mine's worse. It gives people context that this is what's going on. There's not much you could do about it other than predicting the future and sitting in cash. Or if you'd bowed out a little bit early, if you had some sort of stop loss going on. But the point was that the person said, well, what's going to happen to their retirement now? And with the benefit of hindsight, they wish they'd maybe cashed out earlier. And I mean, you can't go around thinking like that, because we could all say that because if the market had rallied even more, he could have said, I wish with the benefit of hindsight, I didn't taken more risk. But what I wanted to do was put out there to people that they have options, because obviously the first thing that person would think is, I'm 25% down, I'm 100 grand less in my pension. Oh my goodness, my retirement, what's it going to look like? And of course, people have options when it comes to retirement. So when you look at that, you think, well, that person had 3 years to go until they were going to retire. It doesn't sound like a lot, but markets such as the one that we're in now, as we talked about last week, tend to recover within sort of 2 to 3 years, as much as 5 years. But the recovery will usually have happened within 3 years. It's not guaranteed, but just to give people some comfort that even though you're that close to retirement, the market might be able to recover. Obviously, when you're getting close to retirement, you should be thinking about reducing your risk anyway. If you're worried about the size of your pension fund, I've talked about this before. Ironically, sometimes having more risk when you've got a bigger pot helps to boost your obviously potential retirement. But of course, the downside is it can hamper it if you get one of these once in a decade type events. But if you reduce the risk that you're taking with your pension as you near retirement, then it reduces the chances of you losing your money. So it's that's a lesson for everybody else. But of course, for this person, their money may have time to recover. But the other thing is, they don't have to take all their pension at once. So they may take some of that pension, they may access some of it, then it means the rest of it has even longer to recover. Let's say they went into using a form of drawdown. So the pension, it isn't all got to be all or nothing when they're at 55. Also, the person mentioned they had some cash. Now, it may be that people have cash in other areas of like savings that they can use in the interim till things recover. The other thing is that you don't have to stop working, and it's an option. And I know people like the idea that I want to retire, that was their line in the sand, but you have to be flexible about these things. But the beauty of it is you do have an option. And for most people, hopefully, I know we're in a particularly fragile state of an economy. We don't know where things are going to be in the future. But hopefully they will be able to keep their jobs, or they'll be able to keep working. So they could always work for an extra year or two until things start to recover. And that is an option that they have. So you've got to think about what your options are. They may not always be the option that you'd hoped for, but then you have to think, we're in almost unprecedented times. So sometimes it will be the fact that you'll have to maybe make choices you didn't want, but at least you have the flexibility to make that choice. So you could work a bit longer. Obviously, the person could save more into their pension if they wanted to. So in a weird way, they could benefit from pound cost averaging on the way down if it eventually recovers. Or they could try and save money if they wanted to in cash for the short term, if they are able to do that, which will mean they won't have to necessarily use their pension fund. One of the things I want people to also think about is budgeting, because when you get to the point that you might retire, if you are going to need to draw some money from your pension fund, you won't necessarily want to do it when the market's down low, because it crystallizes a bigger chunk of your pension. Because if you say need a set amount of money in pounds and pence and your pension fund has tumbled, then percentage wise you're crystallizing more of your pension. So what people might want to do is start to plan ahead now on how they could cut back on their spending. And it may be they have to do that for a period of time into their retirement. I know we'd all love to go into retirement and be on holidays and all these things, but you have a choice, you have the flexibility that you might be able to reduce your costs for a period of time until things recover and get a bit better. So for people who are wanting to try and do that, I mean, as an aside, I've been talking a lot about what makes people feel a bit better in this environment. It's about trying to take control. When you feel you've lost control, it feels awful, it makes people anxious. And so what I've been doing in a few videos is saying to people how to try and take that back. And one of the ways to do that is to quantify your spending, and it's planning ahead. Some people will have to do this now because they're having to spend less money because they maybe have to take a reduced income from their jobs or lost their jobs, etc., or their businesses under strain. Use things like the Emma app is one of them, which enables you to link it up with your bank account. The app then just analyzes all your spending. It puts it into categories such as eating out, shopping, food shopping, all various different things, transport. It looks at all your regular payments. A huge number of people don't know the commitments they have on a month by month basis, how much they spend on direct debits and standing orders. It pulls all that down, and very, very quickly you can see where you can start to cut back on your spending. If not now, then potentially in the future. And it makes you look at the bills you're paying and start to try and control them. I mean, there are things like Monzo and Starling out there, those kind of app-only banks that do this already, all within their own apps. But if you have a bank that doesn't do it, there are a lot of them that don't, then you might want to use a third-party app, and they link in via an API securely to get the data. And I think that is a way, I mean, I've done this, and it's all partly, like I say, in preparation, taking back control, looking at what I was spending money on, gym memberships that I didn't need to do because I can't go out, things like services that you might pay for in terms of energy bills. Can you reduce those? Are there other ways you can cut back on? I mean, food is unfortunately going to go up in price at the moment because of there's less offers. We're having to stay home and eat more in the house. So there are lots of things you can do by looking at your bills and start to scale them back. Make use of that time. And the other thing is, do go and have a look at the benefits that are out there for if you start to struggle. So the government's announced a lot of different measures that for helping the employed and the self-employed, about payment holidays, about grants and loans for businesses. So go and make sure that you are aware of what those are. And there's a whole load of schemes. Even if you think you don't need them, you should prepare and know what they are in case the worst happens. Like what you need to bear in mind, the pros and cons and everything like that. You just need to know what help is out there even if you don't need it. So for people nearing retirement, they should be doing all of this as well. One thing I'd like to mention is about people who live off the yield on their pension. So you might invest in like equity income funds or shares, and you live off the dividend income that's generated by them. One of the things that's going to happen, obviously, in this environment is those dividends are likely to dry up a bit. And if they dry up, then it will mean that your income will be reduced. Now, obviously, if you hold equity income funds, that's much more diversified because they invest in 50, 100 companies. So if the dividends of those individual companies start to be paused or reduced, then the impact will be less so felt by you if the fund is very well diversified. And also investment trusts are able to smooth out some of those payment dips because of their structure. But the one thing I just want to iterate is that if you do this you have an income portfolio and you live use that. Of course, the capital value of your pension will have fallen, and you're not so worried about that if you don't have to dip into it, because the yield produced by your pension is enough to live off. What you also need to do, and should be doing already, is having a cash buffer. So you have a cash buffer of a year's income, or up to 2 years, depends, different schools of thought, and you take your income from that cash buffer within your pension. And at the same time, the equity income funds or the dividends from the shares are topping up your pot, your cash pot that's there. So therefore, it smooths out periods like this. So you're not having to dip into your pension pot. I know for some people that will be almost like hindsight now, but it's one of the things you should try and get towards, where you have a cash buffer, so you're not living hand to mouth, as it were, on the payouts from income funds or the dividends from shares in particular. On another note, on the taking control, this is kind of branched out into a much broader piece. Another thing to bear in mind is that I think people need to make sure they've got their wills up to date. If they don't have a will, then you can get them done online if you've got a simple will. We've got a couple of articles on that about the best online will writing services. If you go and look on the links below this podcast, Andy will put them in there. I know it seems odd, because if you social distance, how do you get your signature witnessed? But people have been doing it by almost throwing it over the fence to their neighbour to sign to say they've witnessed the signature being done. I mean, it is possible. I've heard of solicitors doing it through Windows and all this sort of stuff through Glass. But it's important that you have them, especially in an environment like this if you have children, because if the worst should happen. Also, do check your life insurance and pension plans. If you have a pension plan, then you really need to have made a death nomination on there. So there'll be a form where you fill in where you say where you would like your pension to go. So who you would like to inherit your pension. Make sure that's filled in and up to date. You can contact your probably HR department if it's a company scheme, or your pension provider if it's a more direct scheme with a pension company, to find out what the death nomination you've got on there is at the moment, and you can download forms. And obviously on life insurance policies as well, you need to make sure that somebody spoke to you about putting them in trust. And there's a lot of people who won't have put a policy in trust, and it would have been a better thing for them to do. It's free to do. It's a form to fill in. And what it means is that the policy, if you die, the funds don't end up in your estate. So A, they're not taxed, and B, they get passed on quicker to the person who you want them to be passed on to. So it's a doubly good reason to do so. So there are two other things to make sure you look at. The other thing is, if you got worried about your finances, try and not to keep worrying about it. What I try and do, and it's a technique I learned from, it was a productivity sort of expert, a book I'd read, that you should try and have a place, maybe it's on your phone, a note or something like that, which is listed as nags. And when you have a thought or something that's starting to worry you, you should put it down in there and write it down for you to come back to at an agreed time, maybe on Monday morning rather than over the weekend when you're trying to enjoy the time with the family. And by doing that, it means that you find it easier to get to sleep. You have a process where you go and look at those nags and you can take action. So it might be a nag about you're worried about your source of income or your business cash flow. And what you'll do is you can go and look at them at the problem then, and you can make decisions without any emotion.
That's really interesting you say that, Damien, because I have started to do that process without even realising it was a thing. Although I don't use an app on my phone, I don't write them down. I've started to do a daily video diary. Now, this diary doesn't go anywhere. It's not being posted online. It's not for anyone else other than myself to look back on in time. And what it does is I actually feel like I've had a mini counselling session with myself, because I've managed to verbalise my thoughts and I feel better for it. Now, my wife and I, we talk a lot anyway, but we're kind of getting sick of each other's voices. Obviously, we love each other dearly, but we're under the same roof. We know each other's nags and concerns, and so we don't need to keep going over the same stuff. It's like going over the same argument again and again. It's not that fruitful. You don't get any resolution. But I found by doing a daily video diary, about 2 minutes, just of my thoughts of the day and my concerns, and then it's done then, and it's almost like I've got rid of that thought, and I feel much better. I'm sleeping better as a result. So yeah, it's weird. I've kind of started doing that.
Yeah, and what you've mentioned there is that's how it's meant to work. You're meant to park it, and then you can come back to it. And in a practical sense, for example, if you're worried about your business, then what you would do is you would then set yourself a task, which would be to check all the potential benefits you may be able to claim and the help from the government, and that becomes a focused thing that you will do at an agreed time, and that helps you stop worrying about it, because you know you will complete that task because you've got a process which allows you to complete that task, if that makes sense.
Yeah, so every time that comes into your brain, you're thinking, that's okay, I've got a solution for that, but I haven't yet got that, but that's for further down the track.
Yeah, and with investing it works. So if you're worried about your portfolio, and you should sit there and go, right, on Monday I'm going to sit down, look at it and make a decision based on a level-headedness and not what's going on in the markets that day, about what you want to do and whether you are going to do anything, put more money in or whatever it may be, panic or whatever. Then what will happen is you make a considered view, and you become productive, and you make a decision that is not emotional. And I think that's incredibly important in this time. So it's interesting that you say you started doing it. It's something that they talk about in terms of productivity. As I say, you put your nags down, the things you're worried about, but then you have a process where you actually take action. And the other final thing I would just throw in there is about trying to keep your options flexible. So it's about flexibility. Sometimes when things are going wrong, you don't have a lot of choice and you have to just firefight and react. But if you do have the option, then I always personally vote for flexibility when it comes to financial decisions. So let's be honest, some people are thinking they're going to take a mortgage holiday and they might not need to. But there are implications if you do take one. It could be that you aren't able to remortgage at a future date because, or certainly not for a period of time until you've paid back that holiday arrears, as it were. And of course that therefore has issues for you further down the line that you might not needed to. So you have to think about, if you do something, what the implications, and if you can, then you always I personally will go for flexibility. And I mean, it's interesting, somebody said to me about whether they should invest or keep the money in cash. Well, it's about whether you can afford it. If it's part of your process that you can afford to drip in each month, great. But if you're worried because you're not going to be able to access the money if you tie it up in investments, and you're worried about what's going to happen in your current environment, then absolutely it makes sense to keep a cash buffer if you haven't already got one, and build a cash buffer if you haven't got one, because again, that gives you flexibility to be able to not have to move out of house or have to do something very drastic, or be able to cope if your business starts to fail or you're made unemployed.
Yeah, it's interesting, the whole cash buffer debate. It almost gets forgotten about, doesn't it, when markets are flying, everyone's just piling in, and it seems to be one of those things that, not necessarily financial planners and stuff, because I think that is regularly quoted, but new investors pile in, but now is a time really when we sort of look back in hindsight and think, yeah, wow, cash buffers really are something that everyone should be considering and thinking of having.
And you'll be dipping into them, which will be uncomfortable, but that's why they're there. That's why you've got one. So on your view, when you were saying about or your practice of doing videos, one thing that I always try and be very deliberate about is remembering how things felt at a time previously. So what's going on now in this world and how you feel is something you need to remember. And the reason I say that is because when this all gets fixed and things blow over, it's very easy for people to become almost very bullish again or complacent. So they won't have a cash buffer. They won't sit there and think about the possibility of banks collapsing or spreading their money around different banks, make sure it's fully covered by the financial services compensation scheme. They won't think about how much they're spending on bills, or they won't budget. All these things, they won't think about the what benefits are they possibly entitled to if things go wrong. There's no kind of disaster recovery or contingency planning. And living through an environment like this has a positive, as long as you remember those lessons, and especially the lessons in investing as well, whether how it felt, what you did, and then learning from that for the future. So I do think that, as you are, noting how you feel about a situation has very positive influences in the future, because you learn from those lessons, and to remember that, because so many people, if you look at the market, everyone forgot what the financial crisis was like. The idea of the market going up and down 5% a day was like alien to everybody. But if you've lived through it, and like I said last week, I remember it very clearly when I worked in the city. This has happened before, and you have to learn those sort of lessons and not become complacent. It's very difficult, but try and learn those lessons. So on that note, I'll hand over to you, Andy. There's me talking about, obviously, make sure you budget, know where your money's going, and that will include things like insurances. which is a nice link into what you're doing, because obviously there's the point about whether you should cancel them and cut back.
Well, that's it. Insurance is one of those things that it's often one of the first things people think about cancelling, and because it's one of the things that you buy in the hope that you never get to use, and it's the fact that you don't actually see the value of the insurance because you never use it that people often overlook it and think, well, that's something I can easily cut because I never use that. But the thing you need to think about is, before you cancel any insurance or think about making cutbacks, is you need to understand exactly what it is that you're covered for. So the first thing I would say before you do any sort of major trimming of your insurance policies, it's obvious advice, but don't just cancel that direct debit, because often with some insurers, once you've cancelled that direct debit, you've effectively broken the contract with them and you may no longer be covered. Some insurance companies will allow you a grace period where you can get that direct debit reset back up and you won't lose cover, but some will actually cancel it from the moment that you stop paying your premiums. So rather than going straight into your bank account and making those cuts, go online. Phone lines are busy at the moment, so it probably isn't best getting on the phone to your insurance companies. All the insurance companies now are updating their policy details online. So just find out what it is through your bank account, find out the cover, go online, work it out what it is you're covered for, because the possibility is you may well rely on that insurance further down the line. So don't make wholesale changes. Also, understand your rights. If you've recently taken out a policy, let's say within the last 14 days, you're allowed to cancel that policy straight away, and you can receive all your money back. So if you're really finding it a pinch and you don't feel that you need that cover, you have a 14-day cancellation period. There's not many people in that situation, let's be honest, who were taking out cover 2 weeks ago, but you have got that right if you have recently taken out a policy. And so if we have a quick look at car insurance, you need to be careful, because you can't just cancel your car insurance policy because you feel like you're not going to be driving for the next few months, because there's a legal requirement for you to have car insurance if you want to park your car on the road.
See, that's interesting, Andy, because we were having this debate the other day, not you and I, but me and somebody else. We were just chatting about the idea, and someone said, oh, well, I don't want to pay car insurance anymore. And I had this very discussion about what was the legal requirement or the rules around having car insurance. So it's interesting that you've covered that.
Yeah, I mean, if you're well within your rights to cancel your car insurance if you feel like you're not going to use it. Now, there's different rules. If you pay for it all up front, then you can cancel it straight away. There may be a cancellation fee, and they may well take whatever that cancellation fee is out of whatever you're due back. But some people pay monthly, and so there'll be a different rule for those, and you'll need to speak to the insurer. But it's key to remember that if you do cancel that car insurance, then you will also have to apply for a SORN. Now, this is to register your vehicle as off-road. Now, if you don't have your own private driveway, then you may find that a bit of a problem, because you cannot legally have that car parked on the road if you don't have car insurance. So that's something you need to think about. Now, for those that are looking to really cut back and consider cutting their insurance policies, one thing you should do and can do is check to see if you're actually doubly insured. Now, what I mean by that is check your bank accounts, check your other areas of your finance where they may actually provide insurance as an additional benefit for you. For example, some package bank accounts will offer additional benefits such as travel insurance, mobile phone insurance, RAC cover, AA cover, things like that. I actually found out, and I didn't know, that I was covered for breakdown cover through getting my car serviced with Nissan. So I saved myself 50 quid just by checking around. So that is something that you should definitely do.
Good. Some good advice there, Andy. So people might be wondering why we didn't cover some of the newly announced schemes actually for the coronavirus that are out there. And I had pondered that for this week's podcast. But what I wanted to do is, it's a very fast moving environment. And as soon as something gets announced, it almost certainly it isn't clarified, and we have to then find out more detail. So I'm doing a lot of that online on Facebook Live and putting notes in the group. But the other thing, do send in your questions regarding A, mortgages, anything you've got to do with mortgages and property, and B, anything to do with things like businesses or the support for self-employed or employed people, because I'm thinking about and trying to set up a Facebook Live where I get an accountant to sit there and answer the questions, and also so you can ask them dynamically live, and also a mortgage company to go through a whole, because the mortgage world is very fast moving at the moment. We're hearing lots of stories of, well, basically the whole property market is coming to a standstill because of the coronavirus. There are mortgage companies who are no longer offering remortgages for people without at least a 40% deposit. That's partly because they're worried about the value of properties and what might happen to the property market. They're pulling new products as well. So it's almost like the mortgage companies are battening down the hatches, partly because they're obviously stretched with staff off of work. But it's also a bit of risk assessment. It's a bit of managing risk out there. So there's a lot of questions that people probably will have if they read the headlines in the press this weekend. So do send them in. You can do it via Twitter, Money to the Masses with the number 2, via email, damien@moneytothemasses.com, and we're going to probably try and do those questions, Q&As, sometime next week.
So that's it, we're done. If you haven't already reviewed the podcast, we would really appreciate if you could pop onto iTunes and give us a review. We're seeing bumper listener numbers at the moment, and that will help us spread the word and reach more people. Good stuff, we're done. Until next time.